latest development also on as far as comments by the Trump's appointee to the Fed to become Fed governor and later on Fed chairman. His name is Stephen Miran, and he suggested, and it's quite important individual actually going to be. He suggested that he believes that the interest rates currently are far too high, and this is based on something he called the neutral interest rates. Economists believe that there is something called neutral interest rates, which is determined by the intersection of supply and demand curves. And so if for instance, at the neutral interest rates, according to this particular view, everything is stable and hunky-dory. The prices are stable, economy is growing instead at stable growth, and everything is great. So the problem here, they say, that if the policy rate deviates from the natural rate or neutral rate, that's where the problem starts. So Miran is of the view that at present the neutral rate is much lower than the federal funds rate. The gap is very wide, which means that the federal funds rate are far too high, or the interest rate policy is far too restrictive. That's what he says. He has calculated that he believes that the interest rate should fall by at least 1.5% very soon, in order to bring it in line with the neutral interest rate. Now, our view is that first of all, the neutral rate is just pie in the sky. Nobody has ever observed such a thing. Nobody knows how to calculate, although economists are pretending that they can calculate using some sophisticated mathematics in order to estimate something which never been seen even. So this is all mumbo jumbo as far as we're concerned. So what it will produce is just another form of interference, another misallocation of resources, and another disruption. But that's what this guy believes. He's going to be at some stage the chairman of the Fed after March next year. So we can expect a very aggressive loose monetary policy or interest rate policy. So this is a very big concern, because his interference, the way the Fed does, his interference is going to be on a much greater scale, which means a greater distortions in financial market, greater disruption of the process of the pool of savings and formation of wealth, which means again economic impoverishment in this sense. So all I would say again, to summarize, that most likely we'll see aggressive lowering of interest rates, and all that will create will start producing some much larger bubbles. The question now again whether it's going to work, and when I'm saying it's going to work in terms of economic activity and markets. Now, if the pool of savings is declining or stagnating as we think it is, then the whole thing is going to fall apart and it's not going to work. If it's still holding, then this policy might produce certain false results, but it may not hold for too long. Again, we are of the view that, or at least we subscribe to the view that the pool of savings is in trouble, given all the reckless fiscal and monetary policies that Fed pursued and the government was pursuing. And I cannot see that Trump is going to lower the government's outlays. On the contrary, with all the politics around, with all the difficulties he is creating. We probably will see more interference, more controls on behalf of the government, and all that is bad news for the formation of real wealth and savings as such.